The following content is provided under a Creative Commons license. Your support will help MIT OpenCourseware continue to offer high-quality educational resources for free. To make a donation or view additional materials from hundreds of MIT courses, visit MIT OpenCourseware at ocw.mit.edu.
We have our guest speaker today from Morgan Stanley, Ivan Masyukov. Dr. Masyukov.
Hello, 1, 2, 3. Can you hear me?
And the microphone will just be recording you, but it doesn't broadcast.
I understood. All right. So I'm Ivan Masyukov. I work in Morgan Stanley, and my background is applied physics and mathematics from Moscow Institute of Physics and Technology. And today we'll be working at the topic of the lecture is regularized pricing and risk models. So we will talk about a typical pricing risk models for for interest rate products, and the important aspect of adding some additional constraints, which mean like adding some regularizers to the model. So we will start from bonds, which is probably the most simple interest rate product on the market. Then we'll discuss swaps. We will build the yield curve, and we will see how yield curve models can be improved to satisfy needs of actual trader. And at the end, we'll look at the very nice example of ill-posed problem of calibrating the two-dimensional volatility surface necessary for volatility model, Monte Carlo simulation, and we'll see how that problem can be solved. During the lecture, if you have any questions, please interrupt. Okay. So what is bond? Bond is a security which is issued if someone, like a borrower, needs money, and it promises to pay some certain fixed amount, some certain cash flows in the future, and request for some money upfront for this. So typical bonds basically are include same periodic payment, let's say like every half year or every year, until maturity, where at maturity the face value is paid, like the biggest sum of money, and again at the beginning the investor is asked to pay some upfront. There are also zero coupon bonds which don't pay anything until the maturity. Okay. And there are very interesting perpetual bonds where they basically you pay some money up front and then you're paid back like infinitely, which sounds like a good deal, but we'll know how to price it right. So those are some diagrams. So the first one is the standard fixed rate bond where like small green arrows represent a periodic payment, and there is a face value added on top of the periodic payment at the maturity of the bond. So this is a typical cash flow diagram used for analysis. Okay, and so arrows up represent something that is, and it's green, right? That is good for us. So it's something that we receive, and red arrow facing down represents something that we have to pay, right? So a zero coupon bond is something, as I said before, is something that you pay up front, and you get back a fixed amount of money in the future. What's interesting about this graph, you can see that the green arrow has a bigger amplitude than the red one, which means that you kind of every time you put like you put $100 now, right? You kind of expect that in return you get more in the future, because if you don't get more in the future, you just don't get this money. Don't put this money, you just keep it in the pocket. So as a result, you get a concept of time value of money. So tomorrow, $100 is always will be more than just $100. And also, if you look at the graph of the fixed rate coupon bond and you sum all of the cash flows here, it looks like you get more than this red one. But again, there is a as further in the future the cash flow is, the more the kind of depreciation, and we call this depreciation a discount factor. Okay, so basically the more in the future the cash flow is, the smaller the discount factor. And so for today the discount factor will be 1. For tomorrow it will be like 0.999. And so forth. And in 30 years, let's say it will probably be like 0.1, depending on current rates in the market. So let's see how we can price the bond. Or not necessarily price, but compute a fair value of future cash flows. So fair value of computer cash flows can be found if we have discount factors. So every discount factor, every cash flow in the future I, which in this particular case will be a coupon times the face value, should be multiplied by the discount factor. And then we also add like a face value discount with a discount factor at the maturity of the instrument. So the way this product trades in the market, okay, is that people buy and sell bonds paying P, right? So it's very important to understand that for bonds, it's not something that we have cash flows which we kind of need to price. It's actually, the price is already known. It's a very liquid. There is a lot of activity on the market, meaning that there is very little uncertainty about that price. So this P is known. And as we know, cash flows is something that's written in the contract, right? So it's something, we have fixed cash flows in the future. So it's always a question about what kind of model we use for the discount factors. So we need a model for discounting. Any questions so far? So one of the simplest models is to use just one parameter to kind of to cover all the discounting. And the discount factor can be represented as E minus Y times Ty. T sub I, where Y is some kind of yield. It's called yield to maturity. Well, the reason why it's exponential, it's natural, right? So if I have like a 0.999 discount factor for today, then and we kind of say, okay, it's the same discounting for tomorrow. We'll have the same discounting for every other day. So we have to multiply them. As a result, the total discounting will be exponential. So if our discount factors are like this, then our price basically can be represented as a linear combination of future cash flows, right? At this point, by the way, we kind of merge together the final coupon with the face value, and we'll just kind of be talking about the coupons only, about cash flows only, and. So the formula for the bond price is this. So basically what's known on the market is P, right? Which is a price that's that instrument is traded. We also have defined cash flows in the future, so we can solve for the yield. So essentially, if we know the bond price, we can find the bond yield. okay? And if we know the bond yield, we can find the bond price, okay? So typically bonds are traded in terms of its price, but some bonds are traded in terms of yield. But again, this is like one-to-one. You can always go back and forth. What's important is what has economic value, right? Is the bond price, okay, and the future cash amounts of cash flows. And when we talk about yield, is not something that's traded. It's actually one of the ways to align future cash flows with the bond price. And that way assumes that we have, again, constant discounting for all time points in the future. And we will see that it may or may not be an optimal case. So what's also important when we're talking about instrument price is to have the model of how that price changes if a market changes. So here we're talking about sensitivity of the bond price to yield, and what is typically done is basically to normalize by the bond price itself, which and then it's called bond duration. So the nice thing about normalizing is that it does then the duration of that bond that you have in your portfolio doesn't really depend on how many bonds you have, right? So it's basically more like a property of the bond itself rather than how many bonds you have in your portfolio. So if you take the previous formula and take the derivative with respect to I, we get the following formula for duration. And we know what the price is, right? And we can rewrite this formula this way, which you see it's a sum of ty's times some weights and divided by the sum of those weights. So it's essentially a weighted sum of time, okay? And those pieces of time, those moments of time, are as more important as I mean, the weights are proportional to present values of future cash flows. So that's why bond duration has a very nice kind of intuitive sense. As a result of that, yeah, and I forgot to mention one thing. So the duration is always negative, right? So we have a sign here because if the bond price goes up, this means that the yield goes down, okay? And if the yield goes up, the bond price goes down. And the explanation is very simple. So yield is kind of the same thing as interest rate on the market. So if those rates go up, this means that there will be a lot of more discounting to the future cash flows. They will be less valuable to me. So I will be less willing to pay for those cash flows. Okay, so it's kind of fundamental that that relationship has a negative sign. So in case of a zero coupon bond, we only have one cash flow in the future. So there is just one weight, and that weight is totally assigned to that last cash flow. So duration of zero coupon bond is always equals to maturity. Duration of regular coupon bond depends, but it always lasts to maturity just because we have a weighted sum formula here. So essentially, that model for the bond duration is kind of assumes that all rates or so we have just one yield number for everything. So kind of all rates go into like in a parallel way, which probably which was okay before the crisis, right? Where kind of rates today are kind of similar to the rates expected in the future, but it's no longer the case. So the rates now, they're higher than like 1 year ago, but they're still much lower than expected in the future. So we expect that the rates will go like very high. So the curve is very steep at the moment. So that model of just one number for everything might not be adequate, and we'll see how we can improve this situation. So it's worth mentioning the second derivative. We already spoke about the price, first derivative of the price with respect to yield, and a second. So for small changes in the yield, you can assume that, I mean, it's linear, so it's okay to use just the first derivative. So second derivative will be necessary for larger movements of the market. Like, for example, as an example, if you are a trader, right, and the bond trades, right? So we call it a cash product. Means that you actually don't need any model to price it. You already have that price, okay? But if you try to explain like why you made lost money today, right? And that the trader always does that at the end of the day. And we always use first derivatives, and we try to explain it, but there is also unexplained, okay? And that unexplained can be quite high on days with large movements. So if you have like in your analytics for the bond convexity, that helps you to include the second derivative and therefore make the second derivative smaller. Sorry, the unexplained smaller. So let's now talk about interest rate swaps. So bond cash flow is basically a stream of fixed cash flow, which means that for certain dates, it's just guaranteed that you will be getting like $100 with certain periodicity. A swap means you exchange fixed payment with respect to some floating, and floating means that the amount of money that you will be getting or paying, okay, receiving or paying, will depend on some market observable. So for interest rate swap, it will be typically, and let's focus on the USD market, it will be a 3-month LIBOR rate. Okay, so it's basically, that rate is published daily, okay, and like if you need to go to the bank and get a 3-month CD, put the money for the 3 months, that rate is already known. Okay, it's actually called LIBOR because it's kind of in between banks, and it's set at 11 a.m. Time, London time. So as a result, we'll already have we'll already know how to price cash flows in the future. So present value of the fixed stream of payments, as we know, will be like this. And there is a floating rate cash flow as well. And the nice thing about the swap is that when you enter the swap, you don't pay any money, right? It's because you just kind of enter the agreement. Rather than when you buy or sell a bond, it's always kind of, there is some exchange of money. For swaps, swaps are designed the way such that so when you make this agreement at a certain moment of time, the fixed rate of the swap is picked in such a way that the present value of fixed minus the floating cash flows will be net to zero. So you can see, I mean, if we rewrite those equations, okay, we can see that the swap rate, which is the most important quantity of the swap and something that's traders basically are most concerned, right? So you first need to define what this swap is. And for USD, you are saying probably like 10-year swap, okay, and this is the rate. So the trader continuously kind of quotes bid and offer levels of the swap rate. So no one is talking about PVs and stuff like that. So it's always the swap rate. So the swap rate is a weighted sum of forward trades. So what and it has a very nice intuitive explanation. So you have some stream of floating cash flows, variable cash flows, which at the moment will probably be low now, but will be high in 10 years, will be much higher in 30 years. So the swap rate for this kind of environment will be kind of an average, right? And again, those weights depend on the discounting factors. So later we will see that because we're talking about bond that having fixed cash flows in the futures and a swap that fixed in exchange of floating. Swap can be hedged with bond. Hedged meaning that you know what the term hedged means, no? Hedging means that if you have just let's say a swap, right? So if market changes, right, you can gain or lose money. So a typical task for the money maker, trader, is that to kind of offset that risk with something. Ideally, you sold one swap, you bought another swap the same way with a different rate, so you kind of locked it in your profit, but you remain with a zero risk. So let's try to construct a yield curve. Why do we need a yield curve? So when we have, let's say, series of swap with different maturities, right? All those swaps will start today, and USD swap will have quarterly payment for the floating leg and 6-month payments of the fixed leg, and you'll have different maturities. But if you try to kind of get discount factors from that information, you will see that you can get those discount factors only for certain dates, okay? But the typical situation is that given on some liquid market instruments, you want to price your entire portfolio, okay, which has continuous spectrum of cash flows from now to 30 years, 40 years, and also for typical like swap portfolio that I personally deal with on a daily basis contains hundreds of thousands of swaps. Okay, every swap has many cash flows. So you need something that can, based on discrete information of reliable liquid instruments on the market, can draw the line, can basically construct the curve, which means that you can so that you are able to get discount factors for any potential day in the future, or you can compute forward trade for every date in the future. So the first step to construct a yield curve is to select input instruments for calibration. So you have a set of instruments and you set of input quotes. Then you also need to kind of decide what kind of properties of that line will be. So you can say, okay, first of all, you need to decide like what quantity will be interpolated. It could be like daily discount factors or daily forward trades, or maybe like 3-month forward trades. Then you select the spline type. So I'm not sure if you are familiar with the splines. Probably you heard about cubic spline, right? Or so there are different types of splines, and some of them are better and some of them are worse for different situations. And you also need to decide like what will be the node points for the spline itself. Okay, and then as a final step, so you have like some mathematical quantity, which like mathematical object where you know what the line is, and you have control points, and you need to adjust your control points such that when you repress your instruments, those instruments are repressed exactly to the same quotes that you find on the market. Have a question?
Is it just like
All right, so let me. All right, so this is a picture of the cubic spline. So spline is a way to, I should say, to draw a smooth curve. This is an example of the cubic spline. So you start to define your node points. Your node points in this case are 1, 10, 20, 40, 80, 160, and 240, right? And then for every of those intervals, okay, the functional form of the shape of this curve is a cubic polynomial, okay? Well, if you just do cubic polynomial for every interval without kind of putting additional constraints, you can have all kinds of boundary effects like jumps, kinks, and other things. Because we want our cubic curve, cubic spline to be meaningful, right? So we want to maintain, to preserve maximum number of derivatives for every node point. So we're not going to check, but believe me, this curve has it is a cubic polynomial for every those interval, and also we have two continuous derivatives at every node point, because you, for the n degree of the spline, you always have like n minus 1. You can have n minus 1. So the same thing, a spline can be represented in terms of B-splines. B-spline is a new type of the spline. It's just as a representation, which is more intuitive, I should say. So all universe of the curves with those node points and with two continuous derivatives can be represented as a linear combination of those basis functions. So B-spline is, I mean, if you're interested, you should probably, we're not going to discuss it in details, but it's a nice separate kind of topic about how to build those B-splines. But essentially, what's nice about those B-splines, and B, as you probably already understood, is B is the basis, right? So you have like basis functions. So those functions look like bell shapes. They are non-zero on some sub-interval. On every interval, it will be a cubic polynomial. Everyone will have always two continuous derivatives. As a result, any linear combination of those, which the first curve is, okay, will also have that property. Okay, so now so the calibrate means that we basically have some solver to make sure that our swaps with the rates for those maturities are actually repriced at par. At par means that the PV is 0. This is a typical example of the yield curve instruments, and we have IRS stands for interest rate swap, and we have maturities from 1 year to 30 years, and the quotes are of 0.33% up to 2.67. So you can see that That's actually is one from my 1-year-old presentation. Rates are quite high these days. So this is an example of the yield curve graph. So again, those are the rates from 0.3 to 3.5, and the shape of the curve is not flat at all, right? So it's actually pretty steep. So for the first like 5 years, it's very steep. Then it reaches the plateau, and then there is some feature there, probably because of some behavior in the 20-year region. So 3-month forward rates is a LIBOR rate. LIBOR is the rate for the 3-month. It's mostly kind of common, and the reason why is because the standard interest rate USD swap has a 3-month frequency for payment or on a floating leg. So if you're talking about like floating rates, it's always 3 months, and it's always LIBOR. So because we already built the curve, now let's see how we can improve the situation with the bond. So we have the curve, so we have the discount factors, right? And we see that those discount factors cannot be obtained on the assumption that you have just one parameter yield for everything, because the curve we know is not flat. So if we just try to price it using those discount factors, try to get a fair price, we probably won't match the market observable. So we need some extra term. And again, here we can use it in a similar form as we did it for the yield. But right now, it's going to be a small correction to the yield curve, rather than kind of really rough assumption about that the curve is flat. Okay. So typically, if the curve magnitude is let's say 3%, okay, so the spread is probably 100 times lower. So having a nice correction is always better, right? And another nice feature is that of this approach for the bond, like if we already built our yield curve model, and we know sensitivities of our portfolio to inputs of the curves, which then transitioned into like differences in discount factors, we can easily apply that to the bond. Okay, we can first find what this spread parameter is to solve for S, knowing P, which is very liquid market tradable, and then we can kind of use consistent model for the bonds and the swaps in our portfolio. Any questions?
Yes. So what does the bond spread tell us about?
That's a very good question. So it's it may tell us something about like bond liquidity, for example, like if it's not liquid or there is some. So it may be related to the bond itself, and sometimes we kind of think that the bond is riskless, which means that, especially if it's issued by U.S. government, which if we can assume that those cash flows in the futures are guaranteed, right? Then I basically will be willing to pay a certain amount of money in discount factors, right? But if you tell me that you will pay me that in the future, I won't be so certain, right? So I'll need to add some kind of credit spread to that. We call it credit spread. As a result, that credit spread will kind of propagate to the spread number. On the other hand, if the bond is really U.S. government issued and is considered to be like guaranteed, then it may be a feature of the swap, okay, where just because of some liquidity situations in swap market, like all of a sudden, let's say all option traders on the street need this 10-year swap, okay, because they kind of need to hedge certain very popular products, volatility products. They'll start to buy it. That spread will change. But what's even more interesting, that spread is tradable by itself. Okay, so you can go to the market and you trade that spread. Moreover, let's look at like 10-year situation. So you have 10-year bond on the market. You have a tradable swap and you have a tradable spread. So the question is, which one is the most liquid? What do you think? The most liquid is the bond, of course. It has much more liquidity. What's surprisingly, the second one it's the spread between the 10-year swap and the bond is traded in the market. So there is more transaction on the spread rather compared to the swap. As a result, when we built our curves, we're not taking like a 10-year swap from the market. Okay, we actually take the yield of the and the spread. And that's how we define the most kind of reliable level of the swap. Of course, we could have just take whatever we observe for the 10-year swap, but it could be off. And also, if you observe, there will be more bid-offer spread there as well. So as an example, let's try to shift one of the inputs of the curve by 1 basis point. And that will result in this kind of deviation of forward rates, which will be combination of basis points. But what's interesting, first of all, it's kind of complicated ring behavior. The reason why is because you are saying that nothing changed before the 9th year, like nothing changed after 9th year, but it's just point in between. So in order to calibrate to that kind of weird condition, right, you need to have like a ripple, like here. But what also is more important is that by shifting 1 year basis point by 1 basis point, the amplitude of shifts in the curve reaches 14 basis points. So not sure if you're familiar, but it's an ill-posed problem, right? So small changes in your inputs can cause large variations in your outputs. This is a very important slide. So the first column is, again, we saw those are our instruments, quotes, and this is the risk of the portfolio. That's something that a trader needs no matter what, right? It basically shows you what happens on the market if different, what will be the change in your portfolio if the market changes. So the meaning of the number, for example, for the 5-year is that if 5-year rate moves up by 1 basis point, we lose minus 700 K. We also marked here yellow points that are more liquid than the others. So now, typical situation is that you need to hedge your portfolio, right? So you need to liquidate your risk, basically saying, okay, given the model that we have, I want to its value to be insensitive to any movements of the on the market. Okay, so for that purpose, what you can do, you can go and you can buy as many 1-year swaps as plus 200, as many 2-year swaps with the risk, which would be the risk of minus 1.3, and so forth, right? Then that always costs you money, right? And that money is kind of proportional to bid offer of that particular instruments, and that bid offer is smaller for liquid instruments and larger for less liquid instruments. So if we multiply by the bid offer, we can see that if we want to hedge our risk, it's going to be quite expensive. It will cost us $3.6 million. Any questions so far? So so traders never hedge every bucket in their risk. Okay, bucket means every line here. So you always see some numbers, but if you try to make every number here 0, which means that if you trade 7 here, you also try to go to the market, find the offsetting 7 here, you'll have to pay too much, and you won't be able to be profitable. So what the traders do, they go if someone asks for the 7 year, they make this transaction, but they go then hedge it from with the more liquid points, which is less expensive to buy. So we need a better model for hedging, and general formulation of that model is presented here. So we have portfolio risk in terms of which is just a vector here, right? And we have hedging portfolio risk. Is basically if you have like candidates of instruments that you can use for portfolio hedging. Again, the risk will be represented in this format in terms of sensitivities to swap rates. And we have weights of that hedging portfolio that we need to find, obviously. So you have this hedging portfolio, you multiply H by X, you get like a risk of this hedging portfolio, you add it to the risk of your portfolio. And then what you need to minimize, you don't need to minimize everything, but you need to take a view, okay, what can happen on the market? What are the typical modes on the market? And so essentially you kind of define your market scenarios, which can be found in a different way. So one of the ways to approach that problem is to use principal component analysis. I know you're already familiar with SVD, and so if D is data of market movements, in metrics movements, then any metrics can be decomposed into using SVD, and we can then look at the spectrum of this decomposition, looking at those eigenvalues, and just pick the ones that look high enough for us. Okay, and just keep that number. And let's, for example, we find that we really investigated this market, and we found that there are just 5 components that drive the market, and the rest is just so little that it's meaningless, right? So on every day, and we're certain that it's just five components, 5 modes of market movements. Then, if we have a curve that consists of 20 points, we don't need to hedge every swap with its corresponding maturity. We can just pick 5 swaps that are liquid enough and cheap enough for us to hedge, and just use them. So let's look now at those typical graphs of those principal components. X-axis is a swap maturity in years, and Y is some kind of relative. Let's think of that as basis points. So blue line is the first component, which is the prevalent. And it kind of, you can see that swap rates, they're basically flattish after 10 years, but the first component is pretty steep, right? And what it says as well is that the main behavior of the market is that rates now do not move, but they will move in the future. And that's basically because Fed is in a hold, right? So they kind of stimulate the market in a way such that the rate remains the same until sometime in the future. Mode number 2 is a kind of like tilting situation. Mode number 3 is a more complex, and we have like several other modes here as well. So now, following our previous general approach to the problem, we formulated here as we have PCA factors here in P. And now, because the number of factors that we selected is the number of hedging instruments, we no longer need to minimize. We can always fit, which we can always achieve like perfect minimization. We can always achieve that 0. So that's why we formulate it as 0. So solving that problem here, and the hedging matrix, this is an example of hedging matrix. So what that matrix says is that if I take 1 year swap and put in my portfolio, empty portfolio, and then I apply my model, I'll have just sensitivity to that particular swap, right? Which kind of makes sense, because if since you use the same instruments to calibrate your yield curve, right, then it should be sensitive to itself only. That's why that matrix is just ones for itself and zeros otherwise. So then, as a result, we get this matrix. Okay, so same portfolio that we had before. This is our PCA matrix. Okay, that translates our risk into those few numbers, right? And because we know it translates our risk, raw risk, in terms of many curve inputs into just 5 most liquid ones, which is 1, 2, 5, 10, and 30. As a result, our translated risk, which tells us what we need to do to hedge our portfolio, is just those numbers. And now if we take a bit of a charge, 0.1 basis points for those, and multiply, we get numbers which are orders of magnitude smaller than we got before, right? So we probably get something like 400. It's not 4 million, 3.6 million anymore. That's exactly what traders do. Okay, so, and different traders have like different opinions of what dynamics of the market is. So, but they always have some model. So disadvantages. So PCA model is something that just formally tuned to historical data. I always say that if you take kind of scramble your like swap maturities in your model, and you do your computation, then you kind of unscramble them, you get exactly the same result, which means that in PCA model there are no kind of, you don't put any constraints on that, like 2 year is very close to 1 year, and 2 year is between 1 year and 5 year. So PCA model or hedging coefficient, so that matrix is not very stable, especially for recent modes in the market. Also because SVD is kind of in the least squares approximation. It's very sensitive to outliers. So there is just one event on the market that kind of one day happened something, like rates went up and then went down significantly. It may have unnecessarily high influence on the outputs. So, and if those coefficients change daily, right, then again it may be too costly. And quite often we just overfit into historical data. So we saying, okay, what can I do? I just take historical data. I prove that my model works would have worked for the last 3 years, right, or the last 3 months. But that doesn't mean that it will work for the next 3 months. So if we kind of try to put some additional constraints or additional thoughts about what this behavior should be, this may improve situation. So PCA interpretation is that risk matrix is a linear combination of principal components producing shift on one hedging instruments at a time. And now the question is, let's forget about historical. Okay, is there any other approach? We know historical is noisy, and it's kind of first step if you want to build a model, but can we do something better? And the answer is yes. So we can say that we have our yield curve in terms of forward rates. And typically, when we build this curve, we observe that it is smooth. Okay, it's smooth not only because we use smooth splines, but also because there is no. I mean, if there is no certainty about some event in 10 years from now, there is no reason to kind of to expect there will be a spike in or some not smooth feature or in the forward trade space. So what we can do is that we can try to minimize those equations where Jacobian is a matrix translating shifts of yield curve inputs into movements of forward trades. So essentially, we will try to penalize non-smoothness. So, and the solution will be like this with some kind of so we will be adding a penalty, okay, and penalty will be a small regularization parameter. So this is as an example that's what we get. Again, here in that model, you can view this matrix as if 1 year rate moves. What it basically, so your drivers are 1, 2, 5, 10s, and 30s. So that's your drivers. Knowing the movements of your drivers, what would be the response to your swap rates? And you know that it will always be 1 to itself, right, as you see here. And in between, it will be kind of a smooth functions. So let's take this moment a broader view at what the pricing model does. And we have a pricing engine. Essentially, it's a way if you have all model parameters, including curves, volatility, surface, everything, right? In order to for those parameters to be consistent with benchmark prices, you need some calibration engine, which matches market observables to the ones that being repriced by the model are output of the pricing engine. And once you make sure that benchmark prices of your model equal or kind of close enough to benchmark prices of the observed on the market, you calibrated the model, then you can essentially you can essentially price your portfolio and get values and risk. So let's look at one of the nice examples of that how that pricing engine and pricing and calibration process works. We'll look at AGI model, which is used to price volatility products. So we're not going to go into too many details about this, but this is the equations of evolution of forward rates that we need for simulation, for Monte Carlo simulation. What we're saying here is the change of the forward rates, because forward rates is the quantity that is being simulated, has some drift, okay, because dt is time, and also it has some dependence on the forward rates in forward rates to the power of beta, right? So if it's log normal model, beta will be 1. If it's normal model, beta will be 0, but in general it's different. Then we have volatility surface, right, which kind of gives you what the number of volatility to use for this calendar and forward time. And we have a correlation and factor structure, which we're not going to talk about here, and this is Brownian motions. So we're not going to go any more complex like this. We'll just start looking at nice two-dimensional surfaces here and see what are the problems of calibrating the volatility surface. Just to give you a diagram of when we look at the surface, what different elements of the surface mean. We can, it's a triangular surface. You have a calendar time, right, and you have a forward time. So your simulation starts at the first vertical line. Okay, so you have forward rates here, as calibrated from the curve as of today. So this is those are square boxes here, square elements. So you need to kind of transition from the first line to the second step using Monte Carlo simulation. And that's when, in order for every arrow here, you need the volatility number. Then once you did your Monte Carlo simulation for the second one, you need ones for the third one. And again, you need data which volatility to use. Okay, so essentially the surface that we'll be looking at on next slides is essentially representing the numbers necessary for this transition. It's volatility for every arrow. So to explain, there are different areas here. Like for example, those will be if one step is 1 year, okay. We're talking about this will be the forward rates in that will be observed in 2 years. That one will be observed as of now for like 1 year from now, but again in 2 years. And so those rates are essential to compute the forward swap rate. And if we do our Monte Carlo simulation, that's essential information that we need to compute like the price for the swaption or option on the swap, which we're not going to discuss here, but just an example. It shows that for different instruments observed in the market, you have quite overlapping areas of sensitivity. So this is a typical example of the volatility surface, where this is calendar time, this is forward time, and It has spikes, but for certain regions, but in general, it's smooth. So why this problem is challenging? It's if we try to compute a triangle matrix which has dimension of 240 by 240, the reason why 240 is because every element is for 3 months, okay, but we need up to 60 years of data, which means that it's 60 by the 4, which is the number of quarters, is 240 by 240. Like if you just need triangle elements, it's 200k elements. So if you try to calibrate everything at the same time, and you formally try to solve your problem, you kind of need to store, or at least to build a matrix of 28k by 28k. And we just don't have memory for this. And we also have very small number of calibration instruments, only in terms of swaptions or caps, which are typical volatility products. We just have relatively small number. So it's an undetermined problem. We also, as we saw on the previous example, areas of sensitivity of different instruments overlap. And it's an ill-posed inverse problem, so which produces unstable solutions. And no matter what we do, right, the resulting surface should be nice, right? Should look nice, because if it has spikes in some at some points in the future, then we either have an economic reason for this, or we claim that this is something that's not realistic. So this is how we approach the problem. So the first step, we represent our volatility surface. And here, even though volatility surface is two-dimensional, we just kind of assign a number for every of those elements, okay, and then represent the surface as a vector, okay. We're saying that the new surface V will be some initial state plus a linear combination of basis functions. And basis functions should correspond to some reasonable functions, okay? But the nice feature is that the number of basis functions will be much smaller than the number of elements that we need to calibrate. But our form we will be very formal here, and we'll try to use same number of basis functions as we have our input instruments. So in case we had 50 input instruments, we select basis functions also the number 50. So we'll use typical Newton-Raphson approach here. We'll compute sensitivities of input of all instruments to perturbations of volatility surface. Okay, we'll build this Jacobian matrix, and then if we made the reasonable assumptions about what is those basis functions are, then we can invert our square Jacobian. And again, the reason why it's square is because we selected same number of basis functions as the number of input instruments. It's actually quite common approach, but it's very often a wrong approach. It produces unstable result, and we will see why. So we converge to exact solution, but now the volatility surface looks like this. So it looks less like a volatility surface, but more like Manhattan skyline. So you have like Hudson River here, and you have like some buildings, right? Obviously, even though it calibrates exactly, right? and you can go and price your portfolio, but probably prices for instruments in the portfolio that are not input instruments for calibration will be meaningless, because they probably just the reason why we need this surface to be smooth is for similar instruments, for similar products in your portfolio, you kind of expect similar prices, right? So if your volatility jumps, that's something that just contradicts with this assumption. So now how can we improve the situation? So we can try to use our basis functions which were selected in terms of piece by constant shift of different areas. We can use a smooth version of that of those splines, but again the result looks better, but still is not good enough. And just to demonstrate that this is an ill-posed problem, an ill-posed problem is something that small changes of your inputs results in insane changes in your output, and this is the typical example. So we keep all the instruments the same, okay? We just change by 1%, which is not a big number, of the 5-year by 10-year 10-year swaption. Results in a quite large change of the volatility surface, but look also at the shape, right? So it's really kind of, you look at one building with an antenna and another building, right? So it's very unreasonable change of the volatility surface. So how we can use ill-posedness to our advantage. So we basically, at this point, we say, well, it's not a requirement to calibrate exactly, just because every instrument that is an input to calibration actually has some tolerance. So even there is no point to calibrate it exactly. So because we know that small variations in inputs can be large variations of outputs, we can put some constraints on the outputs, and actually that may not cost us much in terms of not being able to calibrate exactly, but produce much more meaningful result. And just to be absolutely sure that our output result is our surface is smooth, we can use basis functions that smooth to begin with. So we'll use B-splines, but those will be 2 dimensionals, and we'll talk a little bit more about this. And it's not a requirement for us to have as many basis functions as we have instruments, because we can put some other constraints, like for example we can put like smoothness or gradient smoothness to the surface. So let's pick some relatively high but reasonable number of functions, could be more than the number of input instruments, and see what we can do. So first of all, let's build our basis functions for the surface. So this slide we already saw. That's those we selected to use B-splines, which is very convenient to work with. This is one-dimensional. This is the way we build them typically. So we use the Cox-de Boer recursion formula. You start from linear, right? Then you apply that formula. You transition to the basis set of the second order, and then the next iteration you have the third order, and those ones will be built. So now, if you have if you take those basis functions in one dimension and same basis functions in the other dimension, and then you compute the kind of tensor products, like you multiply them one by one, then you get basis functions with shapes like this. Which means that no matter what we do, right, because every basis function makes sense, then any linear combinations will also be good enough. So to formulate the problem is very simple. So we're saying, okay, the quotes produced by our model should be close enough to what observed in the market with some weights again, but we don't require anymore that those are calibrated exactly. We're going to put some penalty function to the change of the volatility surface, and we're going to put some penalty function to the volatility surface itself. So just in so those are vectors, right? And L1 and L2 are matrices. So just to give you an example, what those matrices should be, like if you are talking about smoothness, if you want to penalize the gradient of the vector, right, then the matrix will consist of rows of 1 and following -1. So what you're saying, okay, if I want to penalize the difference between this and the next. And you do that for every element, okay? And the penalty kind of consists of all penalties that you have, okay? So here we just formulate our problem, right? So we want, because we had the Jacobian, we want to price things close enough, and there are two penalty terms here with different regularization parameters. So once we have this, we can just using linear algebra, the solution is defined here, and this is resulting calibration, which we see is nice and smooth. So if we take the analysis of the calibration inverse problem, let's do that using our linear algebra tools to understand where the problem is coming from. Okay, so A is a matrix translates our model parameters to market observables, and there is some error there, epsilon. Okay, so you can see that your solution is a linear combination of singular values divided by the singular values. Okay, so if your values are high, okay, then that's not a problem. The problem is that once you get very small singular values, okay, the deviation of VI's can result in a large deviation of your reconstructed result, and that's when you have the problem. Okay. So this is described on this slide. So ill post is that small noise of may be significantly amplified by small singular values. And if you have a problem and you don't know how good it is, and whether you can trust it or not, so it's a very standard approach. You compute the condition number, which is the ratio of the maximum to minimum singular values, and if the number is high, which means that there are some very insignificant modes in your input data that can cause substantial changes in your output, and if you know that, it's not comforting, right? So if that mode actually doesn't present in reality, then that's fine, but there is no guarantee, right? So if that happens, then your model basically blows up. And that slide displays exactly that noiseless situation, where it looks like if you don't have any noise and if your model is perfect, okay, then you always are able to calibrate exactly to the market observables. But it's never the case, right? So there is always uncertainty to the numbers that you're calibrating to, and your model is not always perfect. So very standard technique for that particular problem is the Tikhonov regularization, which when you solve your ill-posed problem as trying to minimize x minus y, you add some penalty to the amplitude of to your solution, which essentially saying, okay, give me something reasonable, but something that's not blown up. If we go through this linear algebra and to see how that lambda parameter in the Tikhonov regularization affects the weights of the SVD kind of representation of your solution, we now see that small single values is no longer a problem. Just because we're not dividing by the small number, but actually we are kind of limited by some regularization parameter. And typically, when you apply that regularization, your model is no longer gives you a perfect match, right? But the result is much more meaningful and more stable. Another approach to the problem is and before we go to that slide, so kind of Tikhonov regularization we used for the volatility surface for surface calibration. Here, standard Tikhonov regularization is something that you just penalize the amplitude of the solution itself, but it doesn't have to be the amplitude of the solution. It can be some linear combination of your solution. And in terms of calibrating of volatility surface, we didn't apply penalty to the reconstructed volatility, but we say it's not the amplitude of the solution that we don't like. We don't like non-smoothness, so let's penalize the derivatives of the surface into different angles. Another approach would be to use a truncated SVD, where we say, okay, so we did our single value decomposition, we look at the spectrum or single values, and we find that some numbers look nice and large, some are very small, and we just skip the small ones. It's very similar to the PCA approach for the risk management that we saw before, where we just selected 5 principal components and we ignored the rest. As a result, the model is much more robust. And by doing this, we essentially truncate the null space of the model. If you're familiar with this, it's basically the space that has very small very small single values. So what regularized models gives you is that improved stability. It's absolutely essential for ill-conditioned problems. And it's a more realistic and meaningful result at the expense of some ability to fit exactly the data, but that's something that is quite often is acceptable. It may cause a biased solution, meaning that your solution again may not be exact and may be biased towards some better result. Like for example, if we apply smoothness constraint, the solution would kind of assume a little bit more smooth result than it actually is, but that's acceptable. And the bias, again, can be minimized by by reasonable selection of what quantity you actually don't like. Again, you can say during calibration of our volatility surface, we could have said, you know what, let's just open the textbook and see like what's the regularization. Okay, we find Tikhonov, we start to penalize the amplitude. Then the result won't be good. So we need to think about and say, okay, what exactly we don't like? Like, for example, is like absolutely flat volatility surface good for us? And we find, yeah, that's actually fine. Then if we said that, then penalizing the amplitude doesn't make sense. So we need to penalize something that is a deviation from that perfect flat solution. Or to be more kind of precise, we penalize like the derivative in different directions. So this concludes my presentation today. And there are some useful links if you want to get more information. Thank you. Any questions?
Yes. So regarding the techniques that you use for fitting function for the given data, like you are using spline techniques, what other techniques are generally used? Is the spline the best technique to use?
Well, spline is yes. So spline or interpolation is the same. So we're always talking about interpolation. So you have some limited number of inputs, and you want to draw in between. So there are just two words for this, which is interpolation or splining, which I consider to be the same thing in general.
See, I had a question about the interpolation graph that you had, where the final one was very smooth. When you, as an expert in this, look at that graph and see, I guess, I don't know, just some odd shapes, sort of, at certain parts of the
Here?
curve. Yeah. How do you interpret that, and do you assess that that's a feature of the current sort of market liquidity conditions, or possibly just a mathematical?
Well, first of all, I mean that grid is done like for every element is a 3 month. But what's traded on the market, like typical maturities is 3 month, maybe half year, 1 year, 2 year, 5 year, 10 years. So we should kind of rescale it in a logarithmic scale, or you know what I'm talking about. And then if you do that, then this peak doesn't look a peak anymore. So the reason why it looks like a feature to you is because it's quite sharper than this guy, right? But that's because you have many more like detailed instruments there compared to here. Well, and that's the reason why we selected our basis functions like this. So we selected more node density in the front, just because there are more instruments in the front, kind of, than at the end. So we want our spline to be more detailed at the beginning and kind of just nice and smooth at the end. So that's why those basis functions, which correspond very well to actual instruments that we have in the portfolio, can produce. First of all, you see that spike here too, right? So is it like you can compare this guy to this guy, but essentially it's just they have similar magnitude, but we don't have enough instruments in this area to support any sharper features. So I don't see any problems with this graph. But traders, because they look at this every day, right? And then they calibrate and they see a feature, and then they immediately kind of trying to think, okay, if you see something that you know is not typical, and that sense of typical, non-typical comes with years of experience, right? Then they try to arbitrage this, because if there is a spike in the surface, it's very likely that it will disappear soon.
volatility for, it's used in modeling vol for swaptions, right?
Yeah.
So if you were to actually try and go about making a trade out of some discrepancy that you see, could you kind of describe how you would do that with a swaption? Would you just basically hedge it like regular?
I don't have the screen here, but essentially what traders do, right? So this is that calibrator we actually use, okay? And it's a real-time calibrator. The reason why can be real-time is because there is just simple linear algebra there. Most of stuff like A transpose A can be pre-calculated, so it can be real-time. So they can see this volatility surface moving, like while we connect to actual market data. And once they see there is anomaly on the market, there is something traded which they believe is wrong, okay, they just make an advantage of that. They just make a trade that will be swaption, for example, or maybe some other trade more exotic than swaption, but again having like that dependence on that particular instrument, which would be express your position that this will change like in a day or so. So that's exactly how the desk makes money. So we call it relative value analysis. So if we have a tool like that, you have like a model, you have your input instruments, and you have some regularizer in terms of it could be smoothness, it could be a PCA, it could be a combination of PCA, right? But then that additional information allows you to find anomalies on the market. Once you find those anomalies, you can take an advantage of them, provided that your model is robust enough. And if you are saying, well, I'm kind of doing well and I'm calibrate well with just some smoothness assumption about smoothness of the forward trades, there is nothing more fundamental than this. So if your model is based on fundamental principle, you can expect that it will be more stable in the future, rather than PCA. Because for PCA, you just kind of say, okay, I took the time interval, I kind of did my like regression analysis, whatever. But that doesn't mean that the market will continue to do the same in the future.
I have a question. Just now you derived discounting factor from swap market, and then when you try to price bond, you add premium. You mentioned that actually bond is the most liquid instrument in the market. So
Yeah.
why not you do the other way around by invert a bond to derive the discounting factor from a bond market and then do some adjustment?
Well, that's a very good question. So basically, we could have done that, okay? And some firms do that. The problem is that with swaps, we kind of have those swaps today, they kind of roll every day, okay? They like the swap today starts today, the swaps tomorrow starts tomorrow, and things like that. But bonds do not. Okay, so they basically there is like on-the-run bond, which is the most liquid one, which once the new 10-year bond is issued, then that bond becomes off the run. It's still traded, but then everyone switches to on the run. So if you try to, so you have you don't have like a nice continuous spectrum of bonds. You have kind of concentrations between on the runs and off the runs. And if you want to kind of draw the curve for all of them, you typically cannot do the perfect fit. You kind of need to do the least squares. So it's just more convenient to do that in a swap. But once we build a swap curve, swap trader typically, I should say, always use bonds for hedging, just because bonds are much more liquid. Then we project bonds to the swap curve rather than swaps to the bond curve, which is hard to build.
So in this case, when they switch from on the run and off the run, you're going to expect huge change in the spread factor.
Yeah, so your curve won't be stable just because those roll effects, we call those roll effects, which means that there is something substantial changes on the market, and there may be like such a big demand for this new bond on the market that will make your curve that won't look nice. So there are also traders that just trade bonds, and those typically don't have curves. They rely on some PCA models or some other things.
Thanks again.
Thank you.